What's up everybody, I am Jaspreet Singh, and the people that build wealth through this economic slowdown are going to be the ones that know how to execute a three-step plan. They know how to plan, they know how to execute, and then they know how to evaluate what they're doing with their money and their finances through this type of economic downturn. When it comes to planning, this means understanding the mindset now of your investments, knowing what it is that you want to be paying attention to. Number two, when it comes to executing, now it's actually taking action, knowing what to buy, when to buy, how to buy it, knowing what to do and actually doing it. And third, when it comes to evaluating, now it's monitoring, making sure you made the right investment and sitting back for the long term, making sure that you have the right investments, letting your investments make you more wealthy over time. Let me start by talking about the planning, because this will help you understand the mindset of what's happening. So if we just look at companies, every company is made up of two types of people. You have the owners, and then you have the workers of the company. And the thing that we're never really taught is the mindset of how companies operate. Because the reality is that the executives of a company, which are workers of the company, their goal is to do one thing. It's not to take care of their customers. It's not to take care of their workers. It's to take care of the owners. It's to drive up the profits. If you are an executive at a company, you're the CEO, you're one of the executives, your fiduciary duty is to the shareholders, the owners of a company. So what does that mean? The executives of the company are telling the other workers of the company what to do in order to drive up the profits, which would ultimately drive up the valuation of the company. Now, if you start to put yourself into this mindset and understand the way that this works, you'll start to understand, okay, so the owners of the company own a piece of the company. They own the actual equity, they own the ownership. Well, now the owners don't have to go and work at the company. You do have some overlap where some of the owners are workers. Some companies give equity out to their workers. So you do have overlap in some of these instances. But in the general instance, many owners don't have to work in the company. These are people that just own the company. Like if you invest in the Amazon Corporation, you don't have to go and work at the Amazon company. You just own a piece of the profits. And then when the Amazon stock goes up, you get your share. You can sell your stock for a profit, or if you get a dividend, that's your share of the profit. So the owners are looking for equity. They're looking for the growth in profits. They're looking for the growth in valuation. The workers are working now for a salary. For many of these workers who don't have equity, they don't care about the valuation of a company. All they care about is their salary. Now, what I'm talking about when it comes to planning now is understanding the mindset of the owners, because the owners now are the ones that build the wealth over the long run. And this is where now you can understand that you can be a worker and an owner at the same time, but it requires you to know how to use your money. I'm going to talk about that in number two when it comes to executing. But now when it comes to the mindset of the company, if a company is struggling, if a company is running into issues where they're not selling enough products, they have too much cost, they are not able to make a big profit, what are they going to do? Well, they might have to let go of some of their workers. They might say, all right, our costs are too high, we need to reduce our costs, and we need to let go of some of our workers. We've been seeing layoffs happen around us. Now, what does that mean? Well, that means that these workers just lost their salary. They just lost their paycheck. And who are the people that are going to make these decisions? Well, it's going to be the executives who are driven, again, by their fiduciary duty. Their duty is to the shareholders of the company. Now, this might sound mean, but this is how the system works, so it pays to understand the way that the system works. That way you can use it to your advantage. Now, if you're one of these workers who just get kicked out, now you're going to be upset. You're going to say, well, I just lost my job. But if you were a worker that just got kicked out, who also had equity in the company, now you might understand why the executives did it in the first place, or maybe at least it won't be as painful. So this is why it pays to understand what's going on. But this is where now the owners are going to be working to cut their costs while increasing the revenues, to increase profits anytime you go through these types of volatile markets, because when you have these types of economic downturns and volatile markets, this is where companies now want to start building up cash. They want to start having reserves because nobody knows how long economic downturns will last. And this is where companies now start pinching their pockets because they want to start saving cash instead of investing heavily because they want to have that cushion just in case things get worse. So now, when we talk about planning, you got to understand this is how the system works. You got to understand what's going on here. This way now you can put your mind in the shoes of an owner. That way now you aren't just the one that's getting screwed over. You can actually be one of the people that can now come in and purchase an asset at a discounted price. See, what happens might be counterintuitive, because if a company says, okay, we are now struggling a little bit, we are running into issues where our costs are too high, our revenues are not high enough, and then the company goes out and they start cutting their costs. They start laying people off. You might think that, oh, that's good news because now the costs go down, so maybe the profits go up and the valuation will go up. But many times what happens is actually the opposite. Now, you will see people get laid off, and then the stock valuation, the company valuation goes down because now the owners of the company get worried. Investors, shareholders, people on the stock market get worried because they hear their company is doing layoffs, because maybe this company is struggling. Is this company going to go bankrupt? Is something really wrong with the company? Is something fundamentally wrong with the company? So people start to get scared and they panic and then they start selling. When people start to sell, that brings the price of this stock or this investment down. Now, as the price of the stock or investment goes down, this is where now you have to come in, again, that planning, and you have to understand, is this a good investment or a bad investment? If it's a good investment and the stock price is down, this might be a good time for you to buy, because now this asset, the stock, is on sale. If it's a bad investment and the price is down, you don't want to be buying, because maybe they're going to have to lay off more workers. Maybe they're going to have to lay off all their workers because they're on their way to bankruptcy. Maybe they're going to go into default. Maybe they're going to get bought out. Who knows? This is where if it's a bad company or a struggling company, you don't want to be one of the people that's buying it, which requires you to know how to plan and requires you to know how to research, which brings me to number 2, executing, because now when it comes to actually making this buying decision, you have to know what is a good investment, what is a bad investment. There are actually 2 parts if you want to be able to execute successfully. You have to, 1, be prepared, and then 2, you have to have the right financial education. Let me start with the actual preparedness part and then talk about the financial education part, because when it comes to being prepared, if you have no cash, you have no money to invest, you have no ability to invest, you have no access to capital to invest, well, even if you have the right financial education, if you have a good investment, it's going to be very difficult for you to go out and actually invest in this good priced investment, because you don't have any ability to go out and actually buy this investment. So this requires you to be prepared. And the time that you get prepared is now or before. I mean, you want to start preparing when times are good. That way you can take advantage of opportunities when times are bad. And the way that you can do that is, 1, by spending less money, and 2, by earning more money. Because now if you're earning more money and spending less money, you have a bigger cushion. And then you can take this bigger cushion, put it aside, and now this is money that you have waiting, just looking for a good opportunity. That means maybe you downsize on your car, maybe you downsize on your home, maybe you spend less money, maybe you go out to eat less, maybe you don't go on a couple of vacations, because now you want to have a little bit of cash extra put aside just in case you have an opportunity that comes your way, and that way you have the cash to take advantage of that opportunity. Now let's talk about the financial education of how do you actually find a good investment. Because if we're just talking about the stock market, it's not always intuitive what's a good investment or a bad investment. The first thing that I would recommend you do is use a little bit of your feelings, use a little bit of your gut. Because if it's a company that you heard of, and that you use. Like you go and shop at this company all the time, you give this company a lot of money, you like their product, your friends use this product, well, that's a good sign. Now, that's not the only sign, but that's a good first sign. I mean, just use a little bit of your gut, because if you hate this company, if you hate the product, if you don't like it and you know your friends don't like it, then that's a bad first sign. Use a little bit of your gut, because these things can't always be seen in the numbers. Sometimes people get too tied up, too technical, too focused on just the financials without understanding the feeling of a company, because if it's a big public company, you've probably heard of it. And this will have some sort of sentiment if you like it or if you don't like it, and you want to use this as your first level indicator of whether it's a good company or not. If you enjoy spending your money at a particular company, chances are you will also enjoy investing your money in that company, but it's not guaranteed. This is where now you want to look into the second layer of actually digging into the financials. Now, there's 2 different ways that people like to analyze companies. You have the technical way, and then you have the fundamental way. So I'll put F for fundamental and T for technical. The technical way to look at a company is what traders do. This is when you're looking at stock charts, you're looking at candles, you're looking at different lines to see where the momentum of the company is going, to try to predict where the company is going next. So this is a lot of times people that are looking to buy and sell a company in less than 12 months, many times less than 6 months, sometimes even less than a day. Now, this is not for me. I am not a trader, and everything that we talk about in this video and my channel has nothing to do with trading because I suck at trading. I tried trading once when I was in college for one summer, and it was a big pain, and I realized that I'm not a trader. I'm an investor. I like holding on to companies for the long term, and the way that you do that research now is by doing fundamental analysis. Fundamental analysis means now that you're looking at things like revenues, you're looking at profits, you're looking at the cash flow statements, and then you're looking at things like the executive structure, the profits, the innovation of a company. This way now you can get a feeling of the company, and you're looking for a good price to find a good company, and then this is something you want to hold on for the long term because you found this company that you believe is undervalued based off of your fundamental analysis, and then you're just waiting for the market to realize that this company has a lot more potential. Now, the way that you do this, if you're talking about the financials, is to first use a stock research website. You can check out something like Seeking Alpha or Yahoo Finance. Those are both great sites that have a ton of free information. If you want more, you can always pay for more premium service, premium information. But at least with the basic free information, you will get a ton of information about every company that's public on the stock market. Now, when you're diving into the financials, a couple things that you want to pay attention to are the cash flow statements and the profit and loss statements. So when it comes to the cash flow statements and the profit and loss statements, what you want to be looking at are things like the revenue. And you will see that the revenues have either been growing, staying the same, or declining over the last few years. Now, if you are looking for a good company, you ideally want to look for a company that has revenues that have been growing and profits that have been growing. Or if a company isn't profitable yet because it's more of a growth company, then you want to see the path to profitability getting closer and closer. Now, one thing that I do want to mention is that the numbers don't always give you the full picture, because if you see a company where the revenues are growing but the profits are shrinking, that could mean one of two things. Either it's becoming more expensive to do the business because now the cost of operating is getting much higher, which is not good news, or it could also mean that the company is investing heavily back into their growth, which is good news. So they're making a smaller profit because they're investing more money back into the company to help drive the revenues up higher in the future, which should hopefully also drive up the profits in the future. This is where now you want to dig a little bit deeper. And this is where now, if you're listening into the earnings calls, you will be able to get more information about the company. These earnings calls are required by every public company, meaning every company in the stock market, where every quarter, meaning every 3 months, this company is going to have a meeting, a press conference, where they tell the investors, people like you, anybody can listen in, what's happening with the company, what's going on with the revenue, what's going on with the profits, what they expect for the next quarter, and what happened the previous quarter. These are things that you definitely want to be listening in on if you want to invest in a company fundamentally, because then when you listen to them, you can start to get a gauge of what they're doing, and you can start to understand how good this company is or what's going on with the revenue and their profits. And then you want to dig a little bit deeper. Start looking into the CEO. What kind of person is he or her? Do you like the way that they run their business? Do you like the products that they've been coming out with? This is where you have to do a little bit, again, of that gut check. What do you feel about this company? So you want to look at the financials, you want to look at the numbers, and then you want to do a little bit of the feelings to understand what do you like about the company and do they actually have a good product. Now, if you don't like the idea of being a trader and you also don't like the idea of doing all this type of fundamental analysis because it goes way over your head, then the next best thing is not to invest in individual companies, but to rather invest into ETFs or index funds, where now you're investing into a group of companies using one ticker symbol, and now this ticker symbol gives you exposure to maybe hundreds of companies, because now you're investing into a fund that's giving you exposure to multiple companies. So now you don't have to do all that research for one company. I have other videos on my channel where I talk about how to find ETFs, how to research ETFs, and ETFs you can consider investing in, especially when you are in an economic downturn. So if you want to see more of those, check out my channel because I have other videos on that. And this brings me now to actually number 3, about evaluating your plan. Now, if you do want to learn more about how to invest your money like this and how you can start generating passive income from your investments, we have a free guide on generating passive income. Even if you don't have a ton of money to start, it is completely free. So if you want to read my guide on how to start generating passive income and how to invest your money, I'll put the link to how you can do that down in the description below. Warren Buffett says that the stock market is a device that transfers money from the impatient to the patient. This is where now, as you make your decisions, as you've been prepared, you find the right investments, you go out and invest. Now it's all about being patient, because not only do you have the company trends, which are the micro things, what's going on with your actual investment, but you also have the macro issues, things that are going on with the economy. Sometimes you can invest in a good company which is being hurt by the external economy. This is what you want to be looking for. A good company getting hurt by a bad economy, because now the price of your good investment gets hurt by the bad economy. Now you can buy this good investment at a discount, and then as the economy recovers, the company grows as well, and then your stock price or your investment price goes up. Those are the type of investments that you want to be looking for, and it doesn't have to just be the stock market. It can be stocks. It can be real estate. You can buy actual businesses that you're going to operate yourself. It might be startups. It might be cryptocurrency. It really doesn't matter what type of investment that you're investing in. The key is that you want to be looking for assets that get hit by the economy. So you want to find a good and strong asset that's being hurt by the economy, and this is where now the patience and the psychology becomes so important, because you're not going to be able to time the bottom. And so what will happen is you come in and buy, and then many times you're going to see investment go lower, and now you get scared. Oh no. Is it going to go to zero? Or how much lower is it going to go? Should I sell and buy lower, wait for it to go even lower? And what you have to understand is you cannot perfectly time the market. Nobody can. Nobody knows exactly what's going to happen tomorrow, either with a company or with the economy. And along with that, now we have all the things that go on with the Federal Reserve Bank and the government, which can influence the price of assets from the stock market to the real estate market. Because if the Federal Reserve Bank says that they're going to open up the money printer and flood the markets with money, well, the stock market's going to rise. If the government says that they're going to block and ban foreclosures, well, then that's going to prevent the price of real estate from falling. So you have to understand that there's a lot of different factors out there that sometimes you can't control and that sometimes you can't predict. So instead of trying to time the market, instead what you want to do is, again, plan and execute. You want to find the right companies, and then you want to look for a good buying opportunity and then buy, but don't buy all at once. Buy in phases. So now if the investment that you make goes down even more and you know it's a good investment, well, now it's another opportunity for you to come in and buy more aggressively. So you want to buy in phases and buy on the way down. That way you don't just deploy all of your cash and then you see your investments get cut by another 50% and you have no money to come in and buy anymore. But even after you buy an investment, no matter what the investment is, you want to make sure that you're monitoring it. Now, I've been talking about the stock market a lot in this video, so I'll focus on that. If you invest in a company, you want to make sure you keep up with it. You want to make sure you keep evaluating it, and that means you want to keep listening to the earnings calls. You want to keep up with the news of what's going on with the company, because now you want it to monitor. Because now you want to monitor the company and make sure you do not buy on the way to zero. Because if you find out that this company starts struggling more, or that there's more issues, or that the company might go potentially bankrupt, well, then that might be a reason for you to get out quickly. Because now if the company's going to go to zero, you want to make sure you're not holding onto the bag that's going down to zero. And lastly, you want to give your investment time to grow, because now not only are you giving time for your company to grow, become more profitable, to get more users, to get even bigger, but you're also giving time for the economy to grow, because now as the company grows, that's going to make the company more valuable, because now they're making bigger profits, or they have the potential to make bigger profits. But then as the company grows, this means that more people have cash, and this brings up the valuations of companies, which then also makes your investment more valuable. So now it's a win-win. And this is where now the patience becomes so important, because you want to be investing for the long term. And by long term, I mean years, at least 2 or 3 years at the very minimum, instead of just investing your money for 6 months or 9 months. So this is where you have to be patient, let the market do its thing, and invest your money for years, and ideally much longer. Ideally something like 10 years, where now you really give your investment time to grow, you really give your company time to grow, you really give your asset time to grow, because now you're letting the market do its thing, you're letting your asset become more valuable, and now you just get to ride the wave up. Your mind dictates your actions, and so now first thing that you got to do is understand, hey, if I can increase the size of the pie, I don't even have to change the percentage of the money that I'm putting aside. I can just grow the pie, build that growth mindset, and now my percentage that I'm putting aside becomes so much more valuable, because there's a lot more dollars that I can put to work for me.